May 17, 2019, the Nasdaq Stock Exchange, New York. Two Chinese executives stand on the podium as the opening bell rings, Lu Zhengyao and Jenny Qian. Their coffee company is 19 months old. 19 months from first store to Wall Street. No company had done it faster. Investors handed them $561 million that morning. The company was called Luckin Coffee. Its pitch was simple. Starbucks charges too much and China drinks tea. Luckin would make coffee cheap and make China drink it. 11 months after that bell, Luckin admitted the truth. Hundreds of millions of dollars of its sales did not exist. Employees had been manufacturing fake orders at industrial scale. The stock lost 3/4 of its value in a day. Nasdaq threw the company off the exchange. That should be the end of the story. Here is what Luckin looks like today. It is bigger than Starbucks in China. Not slightly bigger, thousands of stores bigger. This is how a company faked $300 million and got caught by people counting cups, and won anyway. Lu Zhengyao and Jenny Qian had done this before. Lu built Car Inc., China's biggest car rental company. He took it public in Hong Kong. Qian was his chief operating officer, the person who ran the machine. In 2017, they left cars for coffee. Same playbook, new product. The Luckin model threw out everything Starbucks did. No cash registers, no counters to linger at. You ordered on the app and only on the app. Most stores were tiny pickup windows with no seats at all. Every new customer got a free coffee. Refer a friend, another free coffee. Beyond that, a stream of discount vouchers. 30% off, 50% off, sometimes more. A cup that listed for 24 yuan sold for 10. Sometimes it sold for nothing. Luckin was losing money on almost every cup. That was the strategy. Burn investor cash to build a habit and fix the prices later. The speed was the product. By the end of 2019, Luckin had 4,507 stores. Starbucks needed 20 years in China to build roughly 4,300. Luckin passed that in 2. Wall Street bought the story. The IPO raised $561 million at $17 a share. By January 17, 2020, the stock closed at $50. The company was worth roughly $12.5 billion. Growth like that needs numbers to keep rising every quarter. Real numbers were not rising fast enough, so somebody started inventing them. The fabrication started small and grew with the guidance. Here is what regulators later established. Through 2019, Luckin invented roughly 2.2 billion yuan in sales, around $300 million. In the third quarter of that year, close to half of its reported revenue was fiction. The mechanics were not sophisticated, they were thorough. Shell companies placed enormous volumes of fake orders through the app. Some were linked to Lu's own business associates. One was reportedly registered to a man who worked in Lu's family gym. The app recorded each fake order as a real sale. Vouchers were redeemed by accounts that belonged to nobody, but fake sales create a problem. Revenue on paper means cash that should exist. Auditors eventually look for it. So money moved in a circle. The same network of shell companies was paid for advertising and supplies. Luckin inflated what it spent on marketing, and the surplus flowed back in as customer revenue. Fake costs paid for fake sales. The books balanced. Individual baristas did not need to know. The orders arrived through the app like any others. Staff made drinks that nobody collected, or the orders went when no drink was made at all. On paper, every store was getting busier every month. The stock kept climbing. One thing should have given it away. A number printed on every single cup. Somebody noticed. Every Luckin order came with a 3-digit pickup number. Order a latte and the app might show 271. The next customer got 272, then 273. The numbers ran in sequence at each store, resetting daily. Delivery orders drew from the same sequence as walk-ins. Think about what that means. The last pickup number of the day is a confession. It tells you exactly how many orders that store processed since morning. Someone realized the app was publishing the evidence. In late 2019, an operation began across China. 92 full-time investigators and around 1,400 part-timers. They sat in Luckin stores with cameras opening to close. They recorded 11,000 hours of video. They collected receipts from more than 25,000 customers, and they ran the number trick. Sit in a store, count every drink handed over in person or to a courier, place one order when you arrive and one before you leave. The gap between your two pickup numbers says how many orders the app claims happened. Compare the app's claim to your count. The difference is invented. Across 151 randomly chosen store days, the app reported 72% more orders than physically existed. One Shanghai store showed 377 real orders on a day the app recorded 609. A store in Chongqing claimed double its actual traffic. Luckin appears to have sensed something. On November 23, 2019, a message went out to store managers. Pickup numbers would now skip at random. Staff were told this was normal, sequential numbers were quietly discontinued, the counters kept counting anyway on video. The findings became an 89-page report. Its author has never been confirmed. The Wall Street Journal later pointed to a Beijing hedge fund, which has never claimed it. Whoever wrote it sent it to the one man guaranteed to use it. Carson Block, founder of Muddy Waters Research, the most famous short seller of Chinese companies alive. Block read someone else's homework and bet his reputation on it. He published all 89 pages on Twitter. January 31st, 2020. Luckin called the report false and misleading. The stock wobbled, then recovered. Wall Street analysts defended the company. For 9 weeks, it looked like the anonymous author had missed. On April 2nd, 2020, Luckin filed a disclosure with American regulators. An internal investigation had found the fraud. Chief Operating Officer Liu Jian and staff under him had fabricated transactions. The fake 2019 sales came to roughly 2.2 billion yuan. The anonymous report had underestimated the fraud. The stock fell more than 75% that day. Trading was halted repeatedly on the way down. 3 days later, Lu Zhengyao posted on WeChat. He said he felt deeply self-reproachful. He accepted, he wrote, more responsibility than the investigation had assigned him. Chinese financial media went further. Caixin reported that investigators found emails from Lu instructing colleagues to commit the fraud. Lu has never been charged with anything. In May, the board fired Jenny Qian and Liu Jian. In June, Nasdaq delisted the company. The stock that had touched $50 ended at 1.38. The regulators took their turns. The SEC fined Luckin $180 million. Chinese authorities fined the company and its shell network about $61 million. China also passed the case to police for criminal investigation. Congress moved too. A new law told Chinese companies on American exchanges to open their audits or leave. Luckin was the case that pushed it through. A fraud exposed, a stock destroyed, executives fired, new laws written, every part of the punishment machine fired exactly once. Watch carefully what happens next, because none of it worked. Here is the strangest fact in this story. During the year Luckin was collapsing, it grew. The company ended 2019 with 4,507 stores. It ended 2020, the year of the delisting and the liquidation lawyers, with 4,803. The scandal happened in New York. The coffee was in China. Chinese customers did not hold shares. They held vouchers. New management understood this. Guo Jinyi, a company insider untouched by the investigation, took over. The founders were forced out entirely. Their shares seized in liquidation. Then Guo changed the machine. The old Luckin sold coffee below cost to buy growth. The new Luckin did something harder. It raised prices gently, cut the wildest discounts and made each cup profitable. And it stopped paying for its own expansion. New stores in smaller cities were opened by franchise partners. Partners put up the capital. Luckin took a cut and controlled the app, the menu, and the supply chain. Growth without spending? The thing the fraud had faked, the franchise model made real. Then came the products. In April 2021, Luckin launched a latte made with coconut milk. It became the biggest product in the company's history and spawned 100 imitators. In September 2023, Luckin partnered with Mutai, the most famous liquor brand in China. An alcohol-flavored latte at 9% the price of a bottle. It sold 5.42 million cups on the first day. The numbers this time were real. In 2023, Luckin passed Starbucks in China revenue. Its store count crossed 20,000, then kept going. Starbucks, after 25 years in China, sat near 7,000. The company Nasdaq, expelled now, outsells the company that invented modern coffee retail. In 2025, Luckin did one more thing. It opened stores in New York City, blocks from the exchange that threw it out. So the fraud was defeated and the business won. That would be a clean ending. The books are not clean. Follow the punishment money because it goes nowhere. Start with the SEC's $180 million fine. It was never actually collected. The penalty was offset against cash. Luckin paid to its own shareholders in the restructuring. The SEC's own court filings confirm it. The United States Treasury received nothing. Now the investors who were defrauded. The class action settled for $175 million. Sounds substantial. Spread across everyone who held the stock, it came to 43 cents per share. The stock had traded at $50. Recovery, less than 1%. The lawyers took $30 million. Now the people. Liu Jian, the operations chief blamed in the disclosure, disappeared from public life. No criminal conviction has ever been reported. Jenny Chien, fired for participating in the fabrication, resurfaced within 2 years. She now runs Cotti Coffee, a chain with more than 10,000 stores. It is Luckin's main low-price rival, and Lu Zhengyao, the man Kai-Shin said instructed the fraud by email, founded Cotti with her. Read that again. The two people at the top of a historic fraud started another coffee company together. It became huge. They now compete against the company they built with fake numbers. Neither has faced a single criminal charge in China or America. China fined some shell companies. America wrote a law. It mostly punished the Chinese companies that had committed no fraud, pushing them off American exchanges. The people who counted cups for months were right about everything. The anonymous author was never named and never collected a reward. Being right, it turns out, was the least profitable position in the entire story. May 17th, 2019, two executives ring a bell in New York. Everything that followed was real and fake at the same time. The stores were real, the coffee was real, the customers were real, the growth curve was invented. The promise had been made before the customers existed. Here is the uncomfortable truth underneath this story. The liars were right. China did want cheap coffee. The app model did work. The business they described to Wall Street in 2019 exists today. They lied about the timing, not the destination. That is exactly why nobody paid. The company was punished, briefly, and recovered. The fine was never collected. The investors got back less than a cent on the dollar. The founders started again, together, and built a second empire. And the only people who never made a yuan sat in the stores, counting cups, writing down the truth. The fraud was the fastest way to describe a real future. In the end, the market decided that was close enough to honest. Somewhere in China today, both coffee chains are handing out vouchers, run by the same people who taught the world what their numbers were worth. Luckin proved that Chinese consumer brands can out-execute Western incumbents through obsessive unit economics and app-first infrastructure. Watch how that same playbook, cold chain logistics, franchise economics, and behavioral psychology, built China's premium tea industry into a $48 billion empire. Watch the absolute insanity of China's $48 billion cheese tea war.